So what I think is likely to happen is we're going to have a credit crisis, and you'll have spiking interest rates. I think the market starts to cascade, just plunge.
Okay.
And I think that will be a truncated period of time. And then the Fed and Treasury will get together and just try to just dump, another round of multiple trillions of dollars in helicopter money. And I think that might work for a while, be stagflation, on steroids, because it'll work to reflate asset bubbles, but I don't think it does anything but damaging the economy much further.
Economy.
And then you have to figure out, will the credit markets behave? If once they assent to interest rate repression infinitely, once they assent to that task, do the shorts and do the sellers overpower the central bank and the Treasury? And if the answer to that question is yes, then there's nothing that can stop it. It's going to go. It's that chart. Those charts will mean revert viciously, quickly, and below that average, that mean.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. When today's guest was back on this channel in July, he warned that a triumvirate of three massive asset price bubbles in credit, real estate, and stocks threatened to take down our fragile economy and dash the retirement hopes for millions. Since then, the bubbles have only expanded. So, will they expand further or pop in 2026? To find out, we've got the great good fortune to welcome money manager Michael Pento back to the program. Michael, thanks so much for joining us today.
Thank you, Adam. It's always a pleasure to be with you.
Hey, same here, my friend. All right, well, look, there's a lot going on in the world right now, so we've got no shortage of things to talk about, and you prepared some slides for us. So I guess I'll get to those pretty quickly. Before we do, let me just kind of ask you at a very high level. I mentioned those three bubbles that you had talked about last time you were on the channel, credit, real estate, and stocks. In your assessment, what's the state of those three bubbles today?
Well, they're humongous, they're record-breaking, and they're getting bigger. Credit, real estate, and the equity market. And we have some charts to show us how we got here and where we are, unfortunately. But then again, after April 9th, when Donald Trump changed from Liberation Day, April 2nd, became, hey, we can work something out on April 9th. We've been in what I call sector 4 of the inflation, deflation, and economic cycle spectrum, which is reflation. So accelerating growth and accelerating inflation on a second derivative basis, which is the best sector to invest in.
Mm-hmm.
So I thank God for the model, because if it divorces me from my emotions, because my emotions have had me wringing my hands for years now. And sometimes I've been correct. 22 was one of those times, but it's not about whether I'm correct or not. Let's just make sure we get this right. This is the biggest bubble in history. Triumvirate of bubbles, they will pop. But as we stand right now, the model says we're in sectors 3 and 4, which is stasis and reflation. Sometimes, in between those two sectors. And I just want one caveat too. So we got to be very idiosyncratic here. We got to be very specific. The last week and a half, we've seen incipient tremors or fractures in the credit markets. Now, I don't know if that's just because of Tricolor and 5 brands, those
first brands.
Oh, yeah, the first brands, those two auto lenders. And it might just be because President Trump threatened 100% increase to 130%. So an additional 100% tariffs on China because of the rare earths ban. That could be it, and they can be recanted very easily. And maybe it is idiosyncratic when it comes to those two auto lenders. But there is an incipient fracturing of my model, which says, hey, you need to be on high alert now, because, and I kind of regret this wasn't like a week from now, because if it was a week from now and things kind of stabilize, where you see the move index contract and you see the VIX contract and you see some of the credit spreads kind of return to quiescence, then it was all for naught, which is like a little blip. It was just because I was just mentioned about the tariffs.
Yeah.
But what if this idiosyncratic and very limited fracturing of auto lenders, subprime auto lenders, is not contained and it does spread? That's a very big possibility. But then again, Adam, you know what? I've come to the conclusion that it is going to be the credit markets. I've been doing this for 35 years, so it's not a flippant conclusion that I've reached. It's why my model was built to identify most assiduously and track most assiduously. It's the fracturing of the credit markets that are going to bring this whole artificial edifice to the ground.
Okay, so I do have some questions for you about some of the cracks that we're seeing. You mentioned some of the names there, and I think one of the things that might be maybe different this time around in the credit markets is that we have private credit playing a much larger role than it had in previous cycles. But I'm going to hold off on those questions because first, Michael, I want to give you a chance to walk through the slides you prepared because I think they're going to provide maybe some foundational insights to then what we'll discuss.
So let's start with this is so critical, and this is the reserves of depository institutions. And maybe a lot of people haven't seen this before, but what I find most remarkable, if you look down, like 1950, 60, 70, this is just a flat line. There's very little reserves in the system, but look what happens when you approach the credit crisis. And it goes, all the way up to here. You're over $3.5 trillion of reserves. In fact, it was over $4 trillion of reserves in the system. This is where all this liquidity. If people say, where's the liquidity coming from? It's coming from your Federal Reserve. It's coming from your central bank, who has printed trillions upon trillions of dollars to keep this bubble afloat. And that is why we're going to see what we see in the next few slides. But I don't know if your whole audience has seen this chart, but I think it's eye-popping to see. And by the way, let me just go in just to make sure everybody understands. This is bank credit. It's part of high-powered money, bank reserves. It can be converted to cash. And the reason why it's high-powered money is because it's also used to back loans. It's liquidity in the banks. It's used to buy bonds. It's used to convert to cash, as I said. So this is critical. This is debt monetization to an extreme level, a banana republic level, if you want to know the truth. Okay, the next.
Right, we went from basically zero in 2010 or 2008 to what, $3.5 trillion now?
Yeah, a little bit less than $3.5 trillion, and that's shocking. It should be shocking to people that you can print that much money and shove it into the banking system and wonder why you financialize the entire U.S. economy. Well, this is the reason. They don't ever. I don't think Jerome Powell ever talks about this. In fact, the only time he talks about reserves is like, hey, we got to make sure there's ample reserves in the system. We're going to get to that in a second. We might as well talk about it now. So Jerome Powell, everybody knows he's cutting interest rates, right? He's also stopping quantitative tightening as well. I mean, the Fed is panicking. And it's mostly because the reverse repo facility, which was, so this is the excess reserves in the banking system, the stuff they didn't need to make loans or to buy things with, to trade with in the repo market. They parked that at the Federal Reserve. It was $2.5 trillion in 2022, and now it's effectively zero. So the Fed knows this, and instead of continuing quantitative tightening, and I'll get to I might as well just get to the Fed's balance sheet then, because I don't want to.
All right. Go to the Fed's balance sheet. I do have a question for you about this, but I'll hold off until you finish here.
So the Fed's balance sheet was $700 billion just prior to the GFC, and it shot up to $9 trillion, and now it's down to about $6.2 trillion. And the Fed is now, and I look back at the latest data. If you zoom in on this chart, I didn't prepare that, but the Fed's balance sheet is actually growing throughout the entire month of October. So we're now actually adding reserves to the system. So, the Fed is panicked about QT. They're panicked about the reverse repo facility. They're panicked that they only have $6.2 trillion of the balance sheet and over 3 trillion in reserves in the system. They're panicked about that. And that's why and if I could just pull my thoughts together from what I was talking about before, what's going to happen is that the credit markets are going to become unglued. That is what's going to end this fantasy. Because you remember Mario Draghi said in 2012, whatever it takes, and that was when the euro bond market was fracturing. And there was a very salient crisis in the pigs, the peripheral, Portugal, Ireland, Italy, Greece. And he said, hey, listen, guys, you can short the bond market if you want to, but I'm going to buy every single sovereign debt issued by the pigs. And you can short if you want to, but you're going to lose because believe me, it's going to be enough. That's what he said. And that actually worked. And the reason why it worked, because it wasn't just insolvency that was a problem in Europe. It wasn't inflation and insolvency. It was just insolvency. But I think we are going to have an inflation and an insolvency crisis in the United States, which is going to burst the sovereign debt bubble and the credit bubble. And then this is when it's game over, Adam. You can't fix an inflation problem by creating more inflation. You can vow to print all the money you can in order to buy long-term US treasuries. But are you also going to buy mortgage-backed securities? Are you also going to buy corporate debt? Are you also going to buy municipal bonds? And if you do, what is that going to do to the inflation rate? If you're going to create all of that credit, I mean, you'll have a crash in the US dollar. And I think the bond market crashes regardless of that. That's not a guarantee, but it's highly likely, highly probable to occur. And then there's nothing the government can do. Because I have people tell me all the time, well, don't you know, Mr. Pento, the Fed and Treasury has your back. They'll do whatever it takes. Yes, they've done that before. And every time they've done it, it's because we've had a recession or a hiccup in the stock market. And we've had deflationary problems. But what if your problem is insolvency and inflation, which it is very likely to occur? That's where we're headed.
Okay.
So I just want to wrap up.
Let me ask a couple questions on here.
Sure.
So the system is a lot more indebted than it was as recently as 2008, right?
Correct.
I don't think you have a chart here of U.S. debt, federal debt, but I think, and I'm doing this from memory, so I could be wrong on the starting point. Was it maybe like, God, I want to say 9 trillion.
It was 40. So you're talking about the U.S. national debt only?
Yeah.
Okay, that was like 40% of GDP in the 1980s.
Okay.
Now it's 100. Now it's like 100. Now it's 123%. But I don't have a chart for you, but I do have later in the slideshow. I have some very important bullet points about the debt that we have, which proves we're in a massive credit bubble. When people, that drives me nuts when people come on TV and they say, well, there isn't any, bubbles in the system. We're not leveraged like that is such a lie. It is a lie. It's either ignorant or mendacious. I don't know which one. Maybe a little bit of both. I don't know. But you have to listen. Yeah, I have about 6 or 7 bullet points about how much debt we have in this country. Total non-financial debt, which includes state, local, federal. It includes private debt, everything but bank debt. Total non-financial debt. And it shows you that we're at an all-time record high. And I don't want to skip there, so I know you have other questions, so I'll let you.
So, Michael, I got a couple questions here for you. The system is much more indebted than it was even as recently as 2008, right? So we've done a lot of shenanigans and deformations, many of which you just talked about here, exploding bank reserves, things like that. Interest rates are higher now than they've been, or than they were for much of the QE and eventual ZERP years that we were in following the global financial crisis, right? So essentially, we have a lot more debt than we had before, and the debt costs a lot more to service because A, it's bigger, and B, the interest rates are still relatively high, right? So when I'm looking at this chart and the other one that you showed, isn't what really matters to the system here the what's it called? Um, the trajectory, if you will, or the rate of change of what's
Mhm.
going on. So here, the bank reserves, while they're still very high at
Right.
3.5 trillion, they're coming down from where they were in 2020. Same thing as you showed the Fed balance sheet. We're tapering there. So I guess my question is, we were goosing everything. Following the global financial crisis, and then that went into overdrive during COVID. But now that it's actually starting to contract, or the rate of change is now no longer positive, it's negative. Does that weigh increasingly more on the credit system? Because we have a credit system now that basically needs to continue to be inflated to be happy. Is that correct?
Well, obviously you're very, very intelligent. So you hit it nail on the head. It's not the actual nominal level of reserves, it's the rate of change. And you just point your attention to remember the repo crisis that we had in 18 and 19? This is what you see right here.
Yep.
And it wasn't the fact, well, who cares? We're down from where we were here to here. And it's still much higher than it was in 2007. No, it's the rate of change that counts. That's what's crucial. And that's why I believe this number here goes higher. I was shocked when I pulled up this morning. I said, so the Fed was threatening to end quantitative tightening. I said, let me see what the Fed's balance sheet is now. And I was shocked to see that it actually has been increasing the entire month of October. So they're already adding reserves to the system before they
Yeah,
stop
they're
quantitative
already
tightening.
taking their foot off the brake. Yeah.
Yes, they're all, and that's why I think, tipping my hat to some of these people that are always so bullish. Yeah, they're lowering interest rates. They're stopping quantitative tightening. They're going to go back into building the Fed's balance sheet. They'll do whatever it takes, and that will boost asset prices
Okay.
until the bond market begins to fracture, and it will. It has
So,
to
so, so,
because of
so,
insolvency and inflation.
so key question here, timing wise, is does the Fed return to that stuff now and assets go higher and hopefully it keeps the credit markets happy for a good while longer? Or are we at the point where the credit markets start cracking and the Fed doesn't start aggressively increasing its balance sheet, refilling the reverse repo program until there's enough pain that it's got the air cover to do that?
Well,
One is an argument that the bubbles are going to keep inflating. One is
yeah,
an argument that, hey, they might get into some rough territory soon, and
well,
that's got to happen before the Fed rides to the rescue.
yeah. I mean, well, it's I'm not in charge of that decision. You're not in charge of that decision. It's the Treasury and the Fed that's in charge of that. It's hard to predict what they're going to do, except knowing what they're already doing. So we haven't had 2% inflation rate for like 4.5 years, over
Hmm.
4.5 years. And so the Fed is cutting interest rates. I mean, they understand they're not in the business to protect the middle class. They're not in the business to keep prices stable. I mean, that's so obvious. They're in the business to protect banks, and
Yeah.
they're going to cut interest rates again. They're seeing what happened to First Brands and Tricolor. They see the reverse repo facility. This is not knowledge that I have, and they don't. They're panicked. As I said already, they're panicked. They're gonna on my view, from what they've shown us already, they're gonna try to preempt this. They're gonna obviate the need to panic because they're panicking now. They're not gonna wait for the credit crisis. They're gonna do it now.
Okay, so I got to
And
jump in then.
that's what I think is gonna happen.
I got to jump in on this then. Okay, so I can understand that argument of, hey, the things haven't fallen apart yet, so the Fed is jumping in now because it is pre-panicking, to your point.
Hmm.
There's others who would make the argument that is, no, the Fed is way behind the curve. The damage is already done. The momentum, to the downside is unstoppable at this point, and we're going to go into some period of pain. Even if the Fed starts now, it's going to be a while before their actions are going to be able to start reversing things. Do you have a strong opinion one way or the other?
I don't. I don't. I maybe 60-40 that they're going to be able to paper over this crisis, but I don't have a strong opinion. I just want to put up this chart real quick to show you what you're talking about here. This is the level of the real Fed funds rate. And you see this period of time here when they were raising interest rates. and they're already going back down. Now, just to show you the anomaly, for most of the period of time between 1955, outside of the stagflation of the late 70s,
Yeah.
all the way to 2000, we had a real Fed funds rate, a positive Fed funds rate. You take the Fed funds rate, the nominal rate minus inflation. It was in
Minus
positive
inflation.
territory. And then you see these 14 years here from 2000, from 2000 all the way to 2022, where we were profoundly negative. Now we just peeked our nose above into positive territory, and you can see the Fed's panicking already. So it's a race. I mean, here's the thing, Adam. I don't have to commit to something. I have a feeling from the reaction function of Jerome Powell, from his history, and especially what he did after COVID. And we had a very, what it turned out to be okay, God bless all the people who die. I'm not trying to minimize the death of from elderly people and people who are susceptible to a pulmonary disease. But we didn't lose a lot of GDP, but we still printed $4.5 trillion,
right,
in a very quick period of time. Powell has inculcated to the markets that he will overreact to a crisis.
Yeah, I think that's accurate. I think that is the expectation.
And if I'm not saying you're correct, this wasn't your point of view, you didn't state your bias, but if this period of time of a real Fed funds rate, where you see the real Fed funds rate recession, real Fed funds rate recession, real Fed funds rate recession, if this was enough to cause a recession, it's going to be truncated most likely, because they're going to come with the cavalry and the Marines. Do you think Donald Trump's going to sit there and stand idly by? And you think Scott Bessent is going to stand idly by? They're going to print. They're going to monetize. They're going to helicopter money. As a matter of fact, I think Donald Trump, who I voted for twice, so don't send me any emails about I'm not a liberal. I'm a libertarian. Okay, there's a difference. There's a huge difference, a trenchant gap between the two. But he's talking about giving a $2,000 stimulus in the form of a cryptocurrency. He's floating it out there. In the greatest economy the world has ever seen, in relatively full employment, we have a very, very low unemployment rate. We have quiescence in the initial jobless claims market, at least before the data went silent. We have 3 asset bubbles. We have record high stock prices. What is the reason why the Fed would be doing this, other than the fact they're panicked over the repo market? Mm-hmm. They're panicked that the excess reserves are starting to dwindle. And they want to make sure the bond market doesn't have any problems. So this is what they're doing now, in my opinion.
Okay, I've got some more questions, but let me let you go through any of your charts before we do.
Here, so look at the trajectory. This is the M2 money supply. And you notice it's a nice, slow, steady incline here. And then you hit 2000 and the slope increases. And then you just go vertical here. This is COVID, vertical. And yes, in the recession we had a big drop in the money supply post-COVID, but here we're increasing again. M2 money supply is a very healthy growth rate of M2 money supply. I'm just building a case, excuse me, as to why we have such a huge bubble. And here's the Fed's balance sheet that shows it was $700 billion prior to the global financial crisis. Going vertical here, COVID kept on going, buying mortgage-backed securities to send housing prices through the roof in March of 2022.
Yeah, I think you probably saw that, but I think Powell finally said, we probably bought the mortgage-backed securities for too long. Like, finally an admission.
Did he consult with his 400 PhD economists to reach that conclusion? Maybe the fact that home prices are going up 20% per annum for a few years, maybe that should have given him a clue when incomes were stagnant. So here's a few examples, just a few. I just picked a few, by the way. This is not, I could have went into student loans. I could have talked about auto loans. I think auto loans now are $1.66 trillion in auto loans. And it was $770 billion in 2007. But here's just a few examples. some good ones too. So leverage loans. What are leverage loans? These are loans to businesses who can't tap the corporate bond market and they can't really get a loan from the bank. In Q3 of this year, there was a record $400 billion in one freaking quarter, almost $500 billion in leverage loans. Adam, this bubble that they've created, I hope I don't sound like a Cassandra. I hope I don't sound hyperbolic because it hasn't really burst yet. But when it bursts, I believe the reason why it's going to burst is because of inflation and insolvency. It's going to be a fracturing of the credit markets. It's going to be unbelievably damaging to the US economy and the global economy. And there's not a darn thing the Treasury or the Fed can do about it when it happens. So here's some more examples. The private credit market has grown from $100 billion. So it didn't even really exist, private credit, in 2007 to $1.7 trillion today. You know, this is larger than the subprime mortgage market. Just any one of these one things, auto loans, student loans, private credit. You know, go try to, you know, private credit is wonderful, except when you want to get your money out. But when you want to get your money out is when you need it the most. That's when you're going to really have regrets about putting money here without doing your due diligence. U.S. margin debt is at an all-time over $1 trillion, up 33% year over year. U.S. margin debt. Sorry. Now here's one for you. This is so key. Total U.S. non-financial debt is now $77.9 trillion, or 256% of GDP. So comparison. Remember, you hear from a lot of people on TV that said there's no distortions, there's no bubble, there's no leverage in the system. It was 19.3 trillion, or 189% of GDP during the NASDAQ bubble, 2000. And even compared to the global financial crisis, so 33.7 to 77.9, and it was less, 230% of GDP. This is according to the Z1. This is not something I pulled out of my hat. Look at the Z.1 and pull it up yourself. Total non-financial debt is higher today than it has ever been in history. That's your debt bubble.
Wow. Those are great stats, Michael. I mean, scary, but great stats.
Thank you. I'm not too happy about them either, Adam, to be honest with you. So what did all this printing and debt monetization do? So here's some, this is courtesy of longtermtrends.net, and they have a different ratio than some, but it shows the same picture. Essentially, this is home price to income ratio. It's above 7 on this database, and it's higher than it was in the housing bubble. This is this is the home price to income ratio. This is not the total cost of owning a home, which includes
right. This is the affordability ratio, which is just housing has never demanded more of a percentage of somebody's income as it does now, and that's why so many people can't buy a house.
Yep. Wilshire 5,000 to GDP. This is scary. Adam, that's 2000. That's 2007.
Isn't that just crazy?
This is where we are today.
Yeah. And I mean, even just recently, like we don't learn, right? 2021, it was at an all-time high. What happened? We had a really painful year the next year, but the markets just said, nah, I think that was a one-off.
That's what all this money printing has done. Now this is a great chart too. This is, I pulled up not only the public value of equities, but the private equity, through the private equity in here too, to GDP. Look at this astronaut. Look at how much greater it is today. This is also right post-COVID, so it's the same. Double top here, maybe. I don't know if you can do that with this metric. Again, 2000 and 2008.
Yeah, it makes us
but look where we are. I mean, you talk about the financialization of, you know, you say if we have a free market economy anymore. Are we a banana republic? I mean, the average. Look at this is the mean of this metric, which includes the bubble. We're way down here. This is where we have to fall to, just to get back to average.
Right. So assuming GDP stayed the same, that would be a 2/3 decline in market value.
Correct, Adam. And guess what? GDP the denominator never stays the same.
Right.
So I don't want to scare people. I'm just I'm just speaking facts here. And finally, this is the FINRA margin debt to GDP, courtesy of Guru Focus.
Yeah, and just to remind people, margin debt is when you are borrowing to buy a financial security.
Correct. So what we have here is a failure to communicate. No, what we have here is the most overvalued, concentrated. The Mag 7 is now 34% of the S&P 500. That is the record per share of the entire 500 stocks. 7 of them are 34%. And it's also the most over-leveraged, overvalued, overly concentrated, and over-leveraged market in history. And I'm still long, but man, I'm gonna tell you something. I run my model every day. I have daily, weekly, monthly components to the model that I have. The inflation, deflation, and economic cycle model. I want to know. I have to know when we're entering into a deflationary, disinflationary recession or credit crisis. I have to know, because the damage could be devastating. I mean, you will not be able to retire comfortably, because listen, the stock, I didn't put this up there either, but the ownership. So to look at the net worth of households, highest concentration in equities in history. Everybody's long. But how many people have a model that tells them when to get out, or are smart enough to avail themselves to programs like yours, to have me, or maybe even more intelligent and more erudite and more eloquent people explain to you how dangerous the situation is? You better have a model, and you better have your finger on the sell button, because otherwise, your retirement is in jeopardy.
All right, Michael. So very sober message. By the way, I don't think it's possible to have a smarter, more eloquent person than you doing this, just for the record. I'm going to go on there.
Thank you.
You're welcome, buddy. Okay, so big question. So you were talking earlier about Fed panicking now, and that it might be able to, kind of foam the runway and prevent markets from crashing here. But in this, same analysis, you're saying, look, we've got this triumvirate of bubbles. They're super extended. If they burst, and we have no historical example of a bubble just continuing forever, the damage is likely to be, extremely painful. I know you're going to do what your model tells you to do when it tells you to do it, but what are you kind of advising folks to prepare for here? Either a move from reflation into stagflation because the Fed has foamed everything and the markets don't correct, but inflation starts becoming a problem? Or are you saying, hey, be careful that the wheels could really come off this thing, the credit market could break, these bubbles could pop, and you could see a bigger chunk of your retirement vaporize faster than you can imagine?
Yeah. So what I think is likely to happen is we're going to have a credit crisis, and you'll have spiking interest rates. I think the market starts to cascade, just plunge.
Okay.
And I think that will be a truncated period of time. And then the Fed and Treasury will get together and just try to just dump, another round of multiple trillions of dollars in helicopter money. And I think that might work for a while, be stagflation, on steroids, because it'll work to reflate asset bubbles, but I don't think it does anything but damaging the economy much further. And then, and I don't have an answer to this yet. It's 3 moves ahead. I'm only good enough to play 2 moves ahead. I can't do 3-dimensional chess like some people, like you, Adam.
I'm a one-dimensional checkers.
By the way, I have to count. I mean, you're looking great lately. I said the hair, everything. You're looking great. So I think then you have to figure out, will the credit markets behave? If once they ascend to interest rate repression infinitely, once they ascend to that task, do the shorts and do the sellers overpower the central bank and the Treasury? And if the answer to that question is yes, then there's nothing that can stop it. It's going to go. It's that chart. Those charts will mean revert viciously, quickly, and below that average, that mean, not the average, the mean. So, but that's 3 steps ahead. I just want to make sure that me and my clients avoid that big, huge drawdown when the initial fracture of the credit markets. And then hopefully participate in the reflation and then see what happens. I mean, if I had to guess, I would say it would not be successful. We're going to end up into a debt jubilee where we just cancel debt. We actually have to get a new currency. I mean, we're heading towards the Argentina Zimbabwe, right?
Okay, so you do think that at some point, and again, I know you're now projecting far out into the future.
Years.
But you think a currency reset is a potentiality.
Right.
Okay, well, thank you for being so transparent. And again, I know what's going to happen is that you are going to do whatever your model tells you to do when it tells you to do it.
Correct.
If and when we get that crack, that breakage in the credit markets that you think we could have, do you expect your model to then tell you to get into deflation? Is that the sector that you would be in, and would you be riding that in those 4 horsemen assets?
Yeah, and depending on the liquidity crisis, to how long it is, I may even have to shed so I have 3. I have silver, I have gold, and I have platinum right now.
Mm-hmm.
We've had them for a while, and I think maybe if you had to answer the question, yes, of course, China stockpiling, India is stockpiling, the Fed is about to cut interest rates. There's so many reasons. Our international creditors no longer want to own treasuries. It's de-dollarization. It's all that. But maybe some of that is presaging what we just talked about. Those charts, mean reverting.
I was going to ask you about that. So you think part of the rise in the precious metals is people sniffing this out?
Yeah, it's de-dollarization. It's no longer parking your savings, China and the rest of the world, Russia, into treasuries. It's negative real interest rates going back to that regime again. It's also, I think it's like, hey, what's going to happen to the banking system if everybody goes the way of First Brands and Tricolor? Yeah. Where am I going to park my savings? So I want it in gold, and as the nominal rate comes down towards zero, there's no lost opportunity cost.
Yeah. Like, well, let me ask you this, since you're such a bond guy. I've been really surprised with the big brands. Bank of America, Goldman Sachs, Morgan Stanley, Jamie Dimon, Jeff Gundlach, Ray Dalio, who've recently come out and said, holding gold kind of makes sense now. And not all those guys, certainly most of those people are not gold bugs. Right. And you're starting to see this, I don't know if these are official recommendations or if these just sort of thought balloons, but them saying, bonds had a great run the past 40 years. They may not have such a great run going forward, especially if they're expecting negative interest rates again. So they're basically saying, yeah, traditional 60-40 portfolio, maybe you want to take part of that 40 that's in bonds and take a healthy chunk of that and put it into gold. And we're seeing people say like maybe 15% of your portfolio, maybe 20% of your portfolio.
Yeah, I know.
And I mean, the bond market's huge compared to the gold market. So is there anything there to that? I mean, do you think a meaningful amount of capital may move into the gold market because it's just looking at the same things you're looking at and saying, man, I think interest rates are going higher, and inflation's going to still be a problem. And yeah, when I get a great real yield, I'm not interested in gold, but when my yield is negative, gold looks actually pretty good.
I've been doing this for 35 years. So I remember in decades after decades of being, someone who've always espoused owning some gold, at least 5% physical gold, being derided and excoriated by the mainstream financial media.
Yep.
Didn't have a place.
It was a radioactive asset.
It's a doorstop. It's a useless rock. It doesn't produce income, blah, 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 blah. But when you look at those charts that I compiled, you say, wait a second, we're going back towards zero. There's no lost opportunity cost. It's a genuine ballast, a genuine offset against the financial system, not Bitcoin, gold, platinum, well, maybe to a lesser extent, platinum and silver, but definitely gold is a viable and mandatory part of a diversified portfolio. I mean, I wouldn't go 20. I would never say 20% all the time. But 5%. And how many people have grown up? I'm 62. How many people have grown up having no gold at all? I mean, no exposure.
99.99% of America?
Yeah. So I mean, gold can easily go to $5,000-$6,000 an ounce in the next few years, easily, in my opinion.
Okay.
And it's
So
not. And by the way, that doesn't mean that I think gold is getting more valuable. It just means the dollar. It's just an offset to the purchasing power of the U.S. dollar.
And you mentioned your concerns about eventually there needing to be a currency reset, and this is
Yep.
basically your safety trade to hang out in against that. Okay. And so look, I know that gold is in your four horsemen deflationary sector. What sector is deflation? What number do you have for that?
One. It's the first sector.
Okay, sector one. But it sounds like you think it's wise to hold some of it now, no matter what sector we're in, whether we're in stasis or reflation or whatever.
So if I'm correct, and we do get the long end of the bond market unmoored, you could get a correction in the gold market. So just be a caveat of that. So bond rates soaring on the long end would be competition, as long as there is some desire to hold the treasury complex. So
Mhm.
I mean, I have to see. I mean, I have to do some technical work on it to see what happens at that time. But yes, it could be something that you always want to have in your portfolio. If you're not an active trader, I would just take 5% of your net worth, come up with a number, and buy physical gold. Well, it's still, below $5,000 an ounce.
Okay. For folks that are interested, just because Michael mentioned it, if you're interested in, if you've never bought any before, you're new to the gold game, and you want to get some direction on where you can buy physical, just go access Thoughtful Money's primer on how to buy and store gold and silver. It's totally free. You just go to thoughtfulmoney.com/gold, and you'll get a good write-up of all the available options there. Okay, Michael, just because you said to set it as a throwaway line, can you briefly, if possible, explain why gold but not Bitcoin?
Well, you said briefly, right?
I did say briefly. If you can't, we'll just move on.
Well, okay, okay. So I'll just be there's gold is not gold is limited because it's an exploding star in the Earth's crust, and it's very hard to pull out of the ground, and it's getting harder and harder, and it costs more money to do so. There's an unlimited number of blockchains. I love the blockchain technology, but there's an unlimited number of blockchain, and hence an unlimited number of coins that can ride along this blockchain in this digital ledger. So I don't care if there's 21 million units of Bitcoin. There's an unlimited number of Bitcoins that can be created, or commodities that serve the same function of a digital currency. So it's not rare, it's not tangible, it's not virtually indestructible, and it'll never be, ever be gold.
Okay, I'm going to leave it there. I'm sure people will have differing opinions, which they will chime in the comments, but I appreciate you putting your stake in the ground. Okay, sorry, question?
I just want to say, before I get excoriated on the comments, yes, I understand that I've been wrong, and you can make a lot of money in the cryptocurrency sphere. It's not something I need to invest in, because I think eventually, why is it over $100,000 a unit? Is because the government has gotten involved and Wall Street has embraced it wholeheartedly. But it's supposed to be something that's decentralized. So there's some antithetical thinking there.
Okay, I'm trying to work my way to private credit, and we're getting tight on time, but now I got to ask another question because you sort of opened the door there to it. What are your thoughts on stablecoins and stablecoins as a means to potentially sop up a lot of the treasury issuance that the government wants to do over the coming year plus?
All right, I'm not an expert in stablecoins, but here's my visceral reaction to stablecoins. You want to buy cryptocurrencies because they're competition for the dollar, a viable alternative to the US dollar, and yet you want to own treasuries with stablecoins, and you want to own the dollar pegged to the US dollar. That's another thing that doesn't make any sense to me.
Okay. All right. Again, I'm sorry, folks. I'm going to leave it there only because we're tight on time here. And I have committed to folks that I am going to do a stablecoin deep dive on stablecoins, and I've actually got somebody lined up for that. We're just trying to nail down a time right now, but in the next week or two, I'll do a video doing a deep dive on stablecoins. All right. So I mentioned earlier that one of the things that's different about this credit cycle is that private credit makes up, I think, a substantially larger percent of the outstanding debt than it had in previous cycles. And because it's private credit, because it's not regulated, we don't have good visibility into the loans that have been made. We're all hoping that people have been making smart loans. But I mean, Michael, I mean, every debt cycle ends because of malinvestment, right? Things get too loose and easy. People make loans they shouldn't have. Those loans start going bad. We have the correction. It's painful, and everybody swears they're never going to make bad loans again, and that lasts for a little while. Right?
Right.
Um, so, Tricolor and First Brands, who we've already mentioned, they were recipients of private credit, and it is raising the question now of, ooh, how many other bad loans are out there in this private credit world? And it's not to say too that even in the regulated world, lending standards maybe weren't as tight as they should have been, or we're beginning to realize, especially, I think on both the corporate and the consumer side, hey, these borrowers were maybe not as creditworthy as we thought.
Yeah.
Yeah. So how different is it this time because of the private credit larger
It's
share?
immensely different. And even I guess I can liken it to private credit as a simile to the housing crisis. It wasn't just subprime mortgages that went bad. Home prices dropped by 33%. So even if you had 20% down and you were a decent credit borrower, you still had no equity in your house, and you lost it in many cases. So I think it's the same thing. In a recession, the loan, even ones that were vetted properly, and it was a viable business, maybe it was in this AI space. It looks good. It looked viable in a booming market, but when the unemployment rate rose and corporate budgets dried up and the cash flow dried up, they turned sour. I
Yeah.
think that's going to happen again. Even
That-
not just to the weak lending, but even the ones that looked solid.
So that's a great point. I just want to interject and I'll let you continue. But we think of subprime and okay, they made the ninja loans and all this. So all these people who shouldn't have been getting debt loans were getting loans. True, right? But what happens in a credit correction is you have a lot of collateral damage, right? So stock prices go down, home prices go down, employees lay off, and you essentially you force a good chunk of the good borrowers into the bad borrower camp, because all of a sudden they can't service their loans because they lost their job or whatever, right? So it's not just a story about the guys who shouldn't have gotten the loans. It's you can drag a lot of the otherwise good lenders down with them, or good borrowers down with them.
Investment grade debt becomes junk in recessions. It never doesn't happen. So it'll happen again. And then my problem is you're spending, you're consuming based on what you have in your private equity fund, because it's not liquid. They tell you what these assets are worth.
Right. It's not mark to market. It's just worth what they tell you it is. Yeah.
And it's spinning off cash flow. And then the cash flow dries up. And then you ask them, what can I sell it? Well, it's illiquid, sir. You can't sell it, or ma'am. You can't get out. But if you do want to get out, it's like 30 cents on the dollar. And then what do you do? And then what happens to your consumption? This is all going to unfold in the next recession or credit crisis. And we have not repealed the business cycle. Things look good today, ostensibly, but when you pull back the very thin veil, it is the most balkanized U.S. economy, where you see the top 20% are doing very, very well, and the bottom 4 quintiles are suffering because of inflation and because their wages haven't kept up with it. And
companies aren't hiring, even though unemployment's low. Companies aren't hiring. Yeah.
Correct. So it's a thin veil that's just higher. It is covering or veiling, which is the word I use. I should have just stuck with it. A very tenuous and fracturing economy.
Okay. Well, beyond that, Michael, everything looks fine, huh? Right? Well, okay. So just for the rubber meets the road here, uh, you know, the magic question is when, right? And that's the unknowable question, right? So, somebody can listen to this discussion we've just had, Michael, and say, oh my God, I didn't realize things were so bad. I got to sell everything right now and get out, right? You're shaking your head right now, right? And this is sort of one of the unfair things about distorted markets like this, is they can continue on for a good long time. And so if you hop off the bus too early, you can lose an awful lot of upside potential and then have challenges getting back into the market, regardless what happens in the future. So to a certain extent, like you as a money manager, you have to play the market you have, but at the same time, you have to, own your fiduciary duty to your clientele and not put them at undue risk. So, how are you managing capital through this, given the fact you have these concerns, but the music is still playing?
Yeah, so as I said, outside of, so we came into 2024 bearish because just because of valuations. So not that we weren't long, we were marginally net long. And that's why we didn't get hurt at all when the April 2nd Liberation Day came out. We had buffers, we had offsets in the portfolio. And then after April 9th, the portfolio, the model started to signal to get longer. So the rate of change of inflation and growth started accelerating. And so we got longer. We've been getting longer throughout the year. And we're very comfortable where we are now. We have lots of precious metals. We have some Indian stocks. We still like, I think that relationship between the United States and India improves in the near future. We own Australian equities. We own IBM as an individual ticker, which is unusual for us. We almost always invest in ETFs. We own aerospace and defense. We own some inflation protection. And we have just one very small ETF that will benefit. It actually buys puts, long-term puts on the stock market. So we're net long, but as I said, I would not
You're
be
net
able
long
to,
with a hedge, it sounds like, yeah.
Yeah, a very small hedge. And you know what? The precious metals also have been,
Or a hedge to a certain extent,
yeah, are hedged to a certain degree. I didn't mention, but I also want to add that I am also short the long end of the bond market now. I'm not sure. I mean, I guess we're up slightly in that position, but not much. But I'm really concerned about a 10-year note that's, near 4% when you have inflation that's 3%, and if nominal growth is at, say, 2 or 3, but they say it's actually, according to the Atlanta Fed, it's closer to like 4 now. So if you add those two numbers up, you look at nominal growth, inflation plus the real growth, you're looking at like 6, 7, 8%, depending on the metric you're using for GDP. And you should never have a 10-year note at 4% if that's the case. So either the economy is going to crash, and then I can assure you my gold and the other actions I'll take. That part of the four horsemen is shorting the market too.
Yep.
So I don't think there's much upside in the long end of the bond market outside of a very severe recession. So that's one of our hedges as well.
Okay. All right. Well, Michael, look, we're at the end of the time here, but thank you for doing your usual excellent job and your incredibly generous transparency that you show in terms of exactly how you're investing or invested right now and how you plan to adapt to whichever new sector your model tells you to go in from here. For people that have very much valued this discussion and would like to follow you in your work, but also you manage capital, and they might say, hey, I might want to talk to Michael about that, where should they go?
So the website is pentoport, PORT.com. And on that, you'll see a subscription to the midweek reality check, which is my weekly podcast. That's $50 a year with a 4 or 5 week free trial. And that gives you my 36,000 foot view of what's going on. It's the salient data and my take on it. And if you're a US citizen and you're qualified for a long short portfolio and you have $100,000 to invest, I'll take you on and put you directly in the inflation, deflation, economic cycle model, which assiduously models and looks at for cracks in the credit markets and financial system, so we can get out and short in time. Because I not only, you see, here's the thing, 95% of what Wall Street does is I call them used carpet salesmen. None of the people on your channel that I know of do that. So they're all active managers. But most of them just say, hey, buy and hold, it always comes back. Buy and hold what? And how long do I have to wait? Do I have to wait like Japan, 35 years? Or China, we're still waiting since 2008, down like 45%. 15 years? And how long, how long to get back to even? You go down 50%, you have to be up 100%. And I don't have that time. Not if you're approaching retirement or in retirement. So I'll handle your money directly using the inflation deflation economic cycle model.
All right, my friend. Michael, thanks so much. It's so great to see you again. Got to have you back on a little bit sooner next time. But just thanks for everything. Really appreciate you coming on again.
Blessings to you and your family.
All right, well, now's the time of the program where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual by Mike Preston and John Lodrich. John, it's great to have you back in town here. We'll get to you in just a sec, but Mike, why don't you kick things off? What were some of your key takeaways from the discussion there with Mr. Pento?
Hello, Adam. Thanks for having us today. We always like Mike Pento. We respect his work. He's in our business, and we think he gets it, just like we think we get it too, in terms of the type of bubble that we're living through and the types of risks that are out there today. Let me try to do a quick recap of what I heard and what I think Mike was saying. There's what's called a triumvirate of bubbles. Mike Pento often talks about credit, real estate, and stocks, and he said that each one of these is larger than when he last came on. I think we'd have to agree. I can't remember actually when Mike was last on, but in general, this bubble has been continuing, so I think it's probably larger than it was even a few months ago. He also said that there's some early alert. His model is giving him alerts. Our model too is not really red alert right now. There's no huge alarm bells going off, nor will there ever be probably big alarm bells going off signaling a top. But our indicators are pretty mixed, and they're probably more leaning towards the bearish side at the moment than anything. So we have to agree that we're seeing some things of concern as well. He says some things that I don't know for sure if he'll be right on, or I'm not even sure if we agree with him. But out of those bubbles he talked about earlier, he thought the credit market would bring the market down, or the credit market would eventually bring the stock market down. Maybe. I really don't know. I don't know what the catalyst will be. I just know that the stock market is ridiculously overvalued and has been for most of the last 15 years, frankly. And so I fully admit that it has been a terrible timing indicator, but valuations have been completely off the map. Just a couple tidbits here that he talked about that I wrote down. Bank reserves went from near zero back at the financial crisis of 2008, 2009, up to 3.5 trillion. Now the Fed balance sheet hit a high of 9 point something trillion. It's six something now, still pretty big. The bank reserves have hit in 3.5 trillion. I've got to agree with him, is a big number. That flooded the whole banking system, and all that money has basically multiplied into the economy. And so it's been the largest bubble ever, really. Certainly the largest bubble in our lifetime. And Mike talked a lot about how dangerous this is for people that are in their retirement or approaching retirement. This time is not like all the other times. It's not like a buy and hold strategy is going to work. We've got to agree with him on this, that we would want to suggest that tactical management is probably the place to be in the next 10 years. And I know that's relatively self-serving because we're tactical managers, but I'm just saying we have to agree with that viewpoint, because it's been such a long time where passive buy and hold has worked because the Federal Reserve has targeted asset price inflation, and a rising tide lifts all boats. And we just know by looking back at history that valuations like this are not conducive with positive returns over the next decade, and they're not conducive with a free lunch, forever. So there's going to be a price to all of this, and he's basically saying that his model has got him on alert. Private credit is greater than it was, nearly double than it was in 2008, up to 1.7 trillion. He threw out some other numbers like car loans are double where they were back then. And he says furthermore that the Fed here is panicking, that they're prioritizing bank stability over middle class interests. And we've talked about that a long time here in this program too. It's just not fair. It's not fair, the amount of wealth equality that has been propagated out of these policies, and that's almost certainly going to have negative consequences. So just a couple more things as I wrap up. Total non-financial debt, 77.9 trillion, more than double that it was 10, 15 years ago. Home price affordability is terrible. A lot of your guests have talked about that too. Over the last bunch of years, home price income ratio, the home price to the income ratio, 7-1. It was more like 3 or 4-1 back in the 70s and 80s. And he's really concerned about a market plunge. I think that we disagree with him on this point. He's really concerned about the long end of the bond curve. In fact, he said that he's got a short there. We're actually long term high quality U.S. Treasury bonds. We think that rates will come down, particularly if we see a big stock market drop. The Fed will drop rates, and both Treasury Secretary Bessent and Trump want rates down, and they've got all the power in the world to get them down, at least in the short term. So our call is that long-term bonds between now and 2 years from now are probably a good place to be. So we'll see who's right on that one.
Mhm.
And lastly, just wrapping up with what he thinks a good strategy is. He's cautiously long. We are too. We're 45% in stocks with some pretty decent hedges. Precious metals, he thinks are a good. I think he said 5% is what he's been long recommended. We have been too, 5 to 10%. A little later in this program, we'll talk about this crazy action in precious metals lately. But here's a hint: we don't really think the move is over, nor should you necessarily rush out of them. And I guess that's about it because my last note talks about active management and physical gold. So I would say 90% of what he said we agree with and is very much in parallel with what we do here in New Harbor.
Okay. You can listen to Michael, and he's so eloquent about all the risks that are out there. I know a lot of people feel like, wow, I mean, should I just get out of the market then if it sounds like this is all really going to come crashing down? And of course, the key element here, if Michael is right about where things will end up, obviously is the timing of it all. And Michael would be the first to tell you, don't trade emotionally. You can, you know, you can get worried and just move to cash, and then you can find yourself sitting in cash for years sometimes as the party continues to rage on, which obviously is why Michael relies so much on his model that he talks about, that he's going to do whatever the stage of the model, whatever stage it's in, tells him to do, right? And right now it tells him to be in the game, even though he's got these concerns and doesn't feel great about it, and he obviously has got some of the hedges in place that he talked about. John, we'll come over to you. Feel free to add anything to Mike's recap. But as Mike said, you guys are still cautiously long here as well. And it sounds like you guys have made some recent changes in the portfolio. I think if I heard you correctly before we turned to the microphone, because some of the targets you had finally got into the price range you were looking for.
Yeah, I'll just echo what Mike said. We're kind of kindred spirits with Michael. Pento and his kind of big picture take on things. The data kind of speaks for itself. The execution maybe varies a bit, but we're talking about big picture things that we are highly aligned on and seeing. I want to just quickly comment. I was away. I had good fortune of being on vacation last week. The ultimate destination was the Galapagos, but we had planned stopovers in Panama City on the way there, and then in Ecuador, mainland Ecuador, on the way home. And a couple observations. I can't help but look through the world in a financial lens, even when I'm on vacation. And a couple of quick things. We had the opportunity to visit the Panama Canal, which is where a tremendous amount of cargo, goods go through, and it was a fascinating experience. And I'll just tell you what, I have no reference point because it's my first time there. Seeing the backlog of ships waiting to get through that canal, at least from that first glance, it didn't look like there was any kind of economic global slowdown in the works. It was pretty fascinating to see these massive ships with 14,000 containers on them going through the canal and backed up in a long queue waiting to get through. It was pretty cool. The other thing I'll notice, the tallest building, I believe, in Panama City is the Bank of China. And I saw firsthand, we've been talking a lot about the BRICS, China and the BRICS, emerging markets trying to de-link from the US dollar and establish their own kind of global trade, alliance, if you will. Well, you can kind of see that playing out in some of these countries, even though many of the brands, the restaurants and stuff are decidedly American, the music they listen to, they use the US dollar. You can see in living color the global posturing going on. Bank of China, tallest building in Panama. Looking at in Quito, Ecuador, we took an Uber. It was a Chinese car. My first time ever riding in a Chinese car, and I forget the name of it, but it had every look and feel of being an American car, or whatever. It seemed like a great car, but it was cool. I was like, "What's this brand I never heard of?" It was a Chinese brand, but living color. You see this global posturing for financial dominance and world dominance playing out when you step outside the borders of the U.S. continent, or country, I should say. The Uber costs were actually pretty amazing. A 20-minute Uber ride, I think, cost me $7, which was, I couldn't believe it, in terms of how cheap things were, even though the US dollar is the currency there. But that's just, I just couldn't help but pass along some of those observations through the eyes of a financial person being on vacation somewhere abroad.
Well, super interesting, and you're just giving me an opportunity here to mention Michael Every's talk at Thoughtful Money's online conference this past weekend. Obviously, getting into the nitty gritty of the increasingly global competition between sometimes allies, sometimes enemies, certainly trade war adversaries right now between U.S. and China. It really is a grand game that is getting played out in real time. Fascinating that you got to actually see it from the front lines there, John.
Yeah, so I was able to unplug mostly. We got a great team here at New Harbor, so I could take a vacation, and we're fortunate to have that situation. But I couldn't help but catch up on some reading, and I just want to pass along some headlines that jumped out at me. First off, there was talk by Jerome Powell that they see in the not too distant future a scaling back or shutting off of the quantitative tightening program that they have been undertaking. Michael Pento shared some charts showing, these are charts we're intimately familiar with as well, but we still have many trillions of dollars of liabilities on the bank balance sheet, the Federal Reserve balance sheet, that basically were a construct of quantitative easing and the printing of money to go out and buy bonds. We're still many multiples higher on that metric than we were, for example, prior to the great financial crisis. And I can recall the interview on 60 Minutes with Ben Bernanke basically saying these measures, they're temporary. We're going to reverse these measures as soon as we possibly can. Here we are 15 years later. Not only are they not reversed, but they're already talking about stopping the reversal of that, right? And another related headline that jumped out, Jerome Powell was asked about, so one of the dirty secrets that many people aren't aware of is one of the primary ways the Fed has been able to raise short-term interest rates off the zero lower bound for much of the last decade is by essentially paying banks interest on reserves that they park at the Fed. Okay, and this is a tactic that is actually rather new. I mean, it just got, I think, approved by Congress in like 2008, or actually 2006, I think it was, and it was meant to be put in place in 2011. And in response to the great financial crisis, they accelerated the time at which the Fed could use this tool. But it basically incents banks to, instead of lending money out and credit creation and flooding all this base money currency into the economy, it incents the banks to park it at the Fed. And they get basically a windfall interest payment that otherwise would be remitted by the Fed to Treasury and benefiting taxpayers. And I want to share a chart here by John Hussman, who we oftentimes talk about, because it's really, I think in a chart kind of paints a really interesting picture. This is a chart he is often referred to. It's called a liquidity preference curve. And basically what it shows here is the amount of bank reserves, currencies that essentially have been printed out of thin air by the Fed as per dollar of nominal GDP. We're right here. Now, we're well off of where we were at the extreme of, quantitative easing and stuff like that, but we're still here. And if not for the fact that the Fed is paying interest to banks, we would be essentially at zero still on short-term interest rates. It's really a construct of the mechanism of interest on excess reserves that has been able to get the Fed to get the short-term rates up to where they are now and where they were. And the thing that struck me is someone asked Jerome Powell, why are you still doing interest on excess reserves? And his comment was something to the effect of, if we eliminate interest on excess reserves, we will lose control of interest rates, meaning like the whole system will kind of like unravel. And that just, I think, is telling that we can't revert back to a normalized balance sheet at the Fed at a time when stock markets are at all-time high, unemployment still really low, growth has been very persistent and stable. What does this say about where we are in kind of the state of the fragility of financial markets? Now we're starting to see talk about credit stresses in private credit and some of the headline subprime lenders and things like that, car lenders. It really just speaks to, I think, this powder keg that we've long talked about, that when this thing kind of hits its first little ripple, it's probably going to be a pretty big event. And the market is utterly complacent about that, as we can see with record high valuations. So I,
Yeah, and
yep.
I just want to note too, I mean, we're starting to see kind of, the crazy speculation that we expect to see sort of near market tops, right? Right now, like we're seeing a lot of meme action in Beyond Meat and Krispy Kreme. That's, these companies that are in fairly pedestrian, sectors, and all of a sudden they're racing off like they're AI stocks.
Yeah, it's crazy. I saw a headline today. The SEC, which is technically under kind of shutdown mode with the government, they came out and issued a press release. Hey, don't worry, we're still watching the market for, I think, quote unquote, hanky panky was the word that was used, and I think they were talking about some of that stuff. But it's really just kind of eye popping, some of this stuff. I just wanted to elaborate a little bit what Mike said on the long bond. Yeah, we're not so concerned about the long bond. And we do think the near-term path is likely going to be, conducive to the long bond. But we have a very small position size. We're about 7.5%. There's enough of these big picture things. I will agree with Mike Pento there that we're at this really tricky phase where, even though the policymakers will probably do what it takes to save the long bond, we're at a point where the consequences of that aren't so easy. They may very quickly be finding themselves with an intractable inflation issue again. And that, as much as they want to save the long bond, that becomes a near impossible thing to do because the bond market starts to vote that they're
Mhm.
concerned about inflation and things like that. So real tricky. We're not heads over tails bullish on the long bond, but we're not scared about the long bond right now either at this
Okay.
short term and juncture.
Well, good recap, John. Again, let me just go back to what I thought I heard before we turned the camera on here. Sounds like you guys have actually entered into a few energy related stocks.
Yeah, we did rotate into a broad basket of energy equipment and services companies. These are, companies like, it's an ETF form, but it contains companies like Schlumberger and Halliburton and stuff like that. These are,
Okay.
companies that tend to do well in the early recovery stages of what otherwise has been a very sluggish energy market. I mean, oil
Okay.
prices have been in the doldrums.
These are fossil energies, right? This is not
Yep,
not nuclear
yep.
type of, yeah.
Yeah, oil and gas type services companies, and fundamentally, we think they've been at good valuations, but the technicals have been very, non supportive until recently. We've seen a very notable technical improvement there, so we did add some exposure there. We remain broadly in the strong sectors that have been leaders much of this year: technology, industrials, utilities. Financials, financials are still strong. We're not in the regional banks. I want to be very clear about that. We're in kind of the more kind of large financial, traditional finance. But there has been some notable weakness there. It's not of concern yet, but it's something that we're watching because it does speak to possibly the financial sector starting to genuinely worry about some of this credit stress that we're seeing in
So,
the
some of
market.
these cockroaches that
Yep,
Jamie Dimon's been talking about.
exactly right. Exactly right.
All right. All right, Mike. Well, just as we start to wrap up here, let's get to you for the big question that's on many viewers' minds for the week, which is, hey, this party train and gold seem to come off the rails a bit. How worried should I be about this? I think that's the question that's on a lot of gold investors' minds right now. What would your answer be?
All right, Adam, I'll try to give you a fair and balanced answer. This trade has been really hot, and not everybody, but many people are emotional about it, and there's lots of questions. So we're getting lots of questions and lots of people asking about how to hedge, even before the recent drop, and afterwards they're wondering if this is the top, if they should do some different things. It's been a pretty breathtaking pullback off the highs last week or late last week. And let me show you a chart of silver, the silver ETF anyway, on a weekly basis. So here is the silver ETF on a weekly basis. We had 11 weeks straight up. We've been talking on this program a long time about this big breakout back here. This is roughly 35 on spot silver. We had this triple top breakout. We added a position to the model right up in here on that breakout. And it was a small position in addition to the precious metals position we already had. And then we've had 11 straight up weeks. So nothing goes in a straight line. And we've been saying actually for a couple of weeks, and we've been saying the trade is getting a little bit crowded, and don't be surprised if you see a pullback. This pullback is a little bit stronger than I expected, in that we went to, if I go back to this monthly chart, you'll see we essentially made a new high above the 2011 high, and then it reversed. It's not likely that it's that simple, that we're going to make a new high and reverse, and then that's the top. That's it. See you later. I know a lot of contrarians are out there on Twitter and whatnot saying that this is probably the top. And Jim Cramer even famously had one on Twitter last night saying, sell into the rally here. And a lot of other people came out and said, well, thank you for saying that, because now we'll do the opposite. But it was a big, big move in a short period of time. So let's go back to the weekly. This thin line is the 21-week moving average. We mentioned the 5-week moving average before, and your previous guest Sven Henrik mentioned this one too. Take a look at the 5 period. We've been saying that we think we could at least come back to tag the 5-week moving average. We just did. So let's go to the daily chart. This is still the 5 period moving average. I'll move that back to the 21 just to make it a little clearer. But on a daily chart, this is a big move. We went from 49 on the CTF down to 43. It's a drop of about 15% in just what, 2 days? But yet on the daily chart, we just kissed the 21-day moving average, which has been support all along, and we're not even down to the 50. So there's nothing, the bottom line is this. We've been saying that you should be selling a little bit into the rally on the way up because it gives you the mental flexibility to stick with it longer term. So hopefully your viewers have been thinking about that and doing some of that. If you haven't done that, that's okay. If you have a position that's not too overweighted, if you've got an appropriate position, if you've got a position of 5-10% silver, something like that, and or gold, I think you're okay. If you're really, really overweighted and you're feeling the heat, let's say you're 50% plus precious metals and our miners, and this is really worrying you, then you probably do want to take a little bounce here to take something off the table. But for the most part, we're not too worried about this. This pullback in silver and in gold, gold did the same thing basically. Gold went up to almost, I think, 4,400 or something and came back to 4,000, but it too just bounced off the 5 period moving average. This allowed us to adjust some hedges. Take a look at GDX, a position in our portfolio. It was amazing to us just how every single day it was up. And it certainly felt like a crowded trade, maybe even a blow off, short-term blow off. And I can admit that it probably was a short-term blow off. But see here, we just bounced off the 50-day moving average today on GDX. So yesterday we actually adjusted hedges. We had some in-the-money calls. We were able to move those up about 3 points, which gave us, 3 or 4 points more upside. And so we were able to cover those hedges, but still keep a really good hedge. The other half of our position has some calls up at 85, so we have lots of upside there. And we're also talking about rebalancing. If we get back up here, we'll probably rebalance back to our target of 10%, but we already did that back here. So I guess my message here is that this is a process. To manage a position properly, you should be rebalancing and or hedging. You should be taking some profits a little bit at a time on the way up so that you don't have to feel panicked when it goes down. In fact, if you sell some on the way up, I'll go back to silver because it's a good example, and your position isn't too big, you can even buy some back on these dips to support. It's a much better flexible mental position than feeling like you've got to be all in. So I don't think we're near a top. I think some of these silver miners, for instance, that have doubled off their lows, might literally double again before things are all said and done. That's what often happens in big bull moves. And so, what would that mean for something like SIL, an ETF that follows silver or something like that? And we went from about 40 to 80. You can see that in just 6 months' time. Wouldn't be surprising to see over the next year or two this thing base out and actually double again. So that's not a prediction or a promise, but I'm just saying everyone's unique and individual. We're not making direct recommendations here. To do that, we'd have to talk to each person individually, which we would be happy to do. But I don't think that this is reason to get emotionally unhinged or too worried. This is the time that frankly, it's an opportunity. And if you're feeling too heavy, it's also an opportunity to rebalance because even at these levels, there's great gains over the last year, 6 months.
Okay, so keep a cool head. And it sounds like you guys at New Harbor are not selling out of any of your positions. Um, it also, again, I mean, I hate to be sort of validated on these things because I know people have to experience pain to get to the validation point. But this is why you hedge, right? And again, you don't, lots of different ways to hedge, and you don't necessarily have to even sell any of your underlying position, your core underlying position. But, knowing that the market had gotten as overstretched as it certainly appeared to be getting, this is sort of what we expected to see here. Now, how far this corrects, is it over? Is it going to continue going down? Nobody knows for sure. That's why we're going to have Mike and John tracking it for us on a week-by-week basis going forward from here. All
Let me
right.
say one more
Well,
thing, Adam, if I
yeah,
can.
go ahead.
Sorry. I meant to say this and I forgot to. Earnings season is here, and it would not be surprising to see some big earnings reports. The first big one coming out is Thursday night for Newmont Mining. So I have no idea how that will come out. But if the earnings season is good, like I think it might be, with all-in sustained cost below $2,000 an ounce on gold, and gold's at 4,000, it could reverse. It could reverse quickly. So
Yeah.
let's see what happens there.
I have heard from a number of gold mining analysts that yeah, the upcoming earnings should be really good for the reasons you mentioned, where that these will be earnings where we've had gold at starting at a great point and getting even better over the quarter, while costs in general didn't increase nearly as quickly as the gold prices. So you're right, that could be something that gets uh, the biggest worries out of the way. So we'll see again. All right. Well, look, folks, if you enjoyed that conversation with Michael Pento, would like to see Michael come back on the program again when he's got an update to his model there. Please let us know that by hitting the like button, then clicking on the subscribe button below. So what was that little bell icon right next to it? Um, we had just an absolutely fantastic, phenomenal conference this past weekend. Mike, you and Justin did a great job there. You definitely carried the torch well in John's absence. But thank you so much for being so involved in that conference. And Mike, I don't need to tell you how fantastic the faculty was during it. I also just released a video the morning we're recording here, guys, kind of giving everybody a quick little highlight snippet from each of the faculty speakers. If you're curious about these conferences and what we talk about then, that's a really good way to get a sense for what was going on. Also, if you do watch it, just note that I probably gave you maybe like 13 minutes in those highlights from what the speakers were saying during the conference. The conference itself was 11 hours. So if you think there's good material in that 13 minutes, just imagine what's in the remaining 10 hours and 47 minutes of the conference. But anyways, if you are regretting not having watched the conference live, don't worry. You can still actually go buy the replay of it. And to do that, just go to thoughtfulmoney.com/conference. And don't forget, if you are a premium subscriber to the Thoughtful Money Substack, use the code I've sent you. You can get an additional $50 off of the price of the replay there. I also want to note too, with inflation going on, we have not raised the price of the conference for a good while now. I don't know if we're going to have to or not in 2026, but I am making conference tickets for our spring conference available at a 0% inflation rate. So if you want to lock in the price of the 2026 conference for the price of the one we just had, you can do that now by going to thoughtfulmoney.com/2026. Lastly, if you would like to get some help in navigating your portfolio through the road ahead, especially if it looks like the type of future that Michael Pento thinks is going to arrive, highly recommend you get that help from a good professional financial advisor, and importantly, one that takes into account the macro issues that my guests like Michael and I talk about in this program regularly. If you've got a good one who's doing that for you, great. Don't mess with success. But if you don't, or you'd like a second opinion from one who does meet that criteria, perhaps you'd like to maybe even speak to John and Mike there at New Harbor Financial, then fill out the very short form at thoughtfulmoney.com and schedule a discussion with one of the advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. These consultations are totally free. There's no commitment involved. It's just a service they offer to help as many people as possible. John and Mike, guys, another good week. John, great to have you back in the saddle. Glad to hear you had such a wonderful trip. And whatever the markets throw at us, I look forward to making sense of it with you guys next week.
Thanks, Adam. Been great as always. We'll see you next week.
Thanks for having us, Adam, and we'll see you soon.
All right. And everybody else, thanks so much for watching.
Silver's breaking out. It looks like 44 is kind of that next upside target. And I got a feeling like when you look at the monthly chart of silver right now with silver, where I think we could go all the way up and we could see it spike. And I think we could get up to that $49, $50 an ounce in silver. I think it could have a blow off phase and shoot higher. Very similar to, what happens near the end of a move is you get a very strong parabolic move. And so I think right now in the precious metal space, money is actually chasing the gold miners and the silver miners. Gold's taking a pause. Money's rotating out of gold because it just had a nice move. And we're seeing it move into like silver miners and gold miners. You can see they're extending and pushing higher. And we were long SILJ. We just hit a 20% target yesterday. We've actually closed that position out. I think now we might see, miners take a bit of a breather and a pause. And as money rotates out of miners with some profit taking, we flip back to gold, and gold has got this little pause that it's just had, and now gold will probably shoot up. So I think they're going to like piggyback on each other. That flows into miners and then flows into gold and goes back and forth.
With $44 as the next objective, silver is currently in a great setup for a breakout. It may reach as high as $49.50 an ounce in a traditional parabolic. The story is being driven by breakthrough technicals, tightening supply, and industrial demand. According to Investing Haven's forecasts, silver will first challenge all-time highs, reaching about $49 in 2025. Money is shifting right now. Investors are pursuing silver and gold miners who have been rising in value, and gold has just rebounded, so they are taking profits there. In order to prepare for the next step higher, miners may now pause as profits are taken. This money might then turn back into gold. Chris Vermeulen is a market strategist and technical analyst. He points out that silver is in a good position. According to a recent commodity forecast, bulls are aiming for $44 if resistance is broken, and silver is now trading close to $42. Although silver is more speculative than gold, both are expected to continue to rise as a result of this rotation. Silver is breaking out, according to technical breakout assessments, both in terms of its absolute price and in relation to stocks from 4-year bases. In certain technical models, medium-term targets of $49 to $50 are repeated. At the same time, gold's consistent increase serves as a warning to markets about anxiety around the world. While IT giants continue to drive U.S. stocks to near-high levels, internal weakness and exuberant sentiment point to the possibility of a significant correction in the near future. There are fissures in well-known industries, momentum and investor confidence are brittle, and valuations are high. Analysts warn that some profit-taking and sideways moves are typical following strong runs, in miners or metals. Although resistance has been breached by silver, further upside is contingent upon maintaining volumes and avoiding reversals. Chris believes when the cycle changes, investors need a strategy to identify trend reversals and safeguard their money. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
Yeah, if we take a look at silver, we haven't traded silver just because gold, our play around silver was the silver miners. And so silver has done the very similar to gold as it's rallied up, and now silver's had a nice bull flag. It's paused. And so silver is breaking out and starting to run. So money's coming, I think, out of miners now and starting to go into silver. And then I think it'll bleed over into gold because silver is much more speculative than gold. So money's going to rotate probably from miners, silver, gold, and then kind of maybe loop around. These are very nuanced, small moves. But silver's breaking out. It looks like 44 is kind of that next upside target. And I got a feeling like when you look at the monthly chart of silver, we're in a sweet scenario right now with silver where I think we could go all the way up and we could see it spike. And I think we could get up to that $49, $50 an ounce in silver. I think it could have a blow off phase and shoot higher. Very similar to, what happens near the end of a move is you get a very strong parabolic move. You cannot trust a move that goes straight up because usually it comes straight back down. Very similar to what happened just before the last financial crisis. It shot straight up, came straight back down, and then sold off for 65%. So I think we have that potential for it to shoot higher still. And of course, that'll be good for silver miners as well. But yeah, right now we're in that sweet spot for precious metals. And you and I have touched on this cycle graph before. If we look at the stock market, this blue cycle here, precious metals really come to life near a major market top. And one of the reasons is people are moving away from, the stock market in general, and they're moving into physical assets, something where they won't lose value or won't blow up on them as much. And industrial capital goods are actually doing really well. When we look at the industrial space, businesses are still bullish, and industrial stocks are rocketing higher. Businesses think, things are good. CEOs and factory workers or management are upgrading their facilities, thinking, this is a little lull maybe for a lot of businesses before it goes higher. But I think the music's about to end. And when everybody's really bullish and they think businesses is just getting started, usually that's when the business goes for a nosedive. We go in for a recession, and they realize they just spent millions on new facilities or assembly lines and all that stuff right when all their demand decreases. So there's a lot of things coming together. And yeah, there's a few key currents. I think looking at the big picture might be important. I think the stock market is getting pretty frothy. If we look at the charts, we'll actually take a look at the big picture and actually go to gold first. So gold, in a nutshell, I'm just going to flip to the monthly chart. Gold has been on a tear, for a couple of years. It's outperforming. It's becoming one of the best performing assets long term. Last time we saw this was like in 2007, just before a major stock market and financial reset in the economy. Gold is kind of a barometer, a global barometer, like planet Earth and the people on. It's like a beehive mentality. The whole world is nervous that something is about to happen, and they tend to move to gold. They move away from equities to some regard. They move away from currencies. They move away from even real estate, and they start to move to gold. They want something physical, something outside of the financial system. And gold is telling us that people are preparing for something bad to happen. We don't know what it is. We don't know, when the shoe is going to fall, and trends are going to change. The economy situation is going to change, but gold has just been on this tear, and it's outperforming, and it's extending to the upside. That is an early warning sign to be careful for the stock market. But if we zoom in now and go to the overall stock market, I'll go to the SPY, which is the S&P 500 ETF. We've obviously had a very nice rally coming out of the lows from this year. We had the big 20+% sell-off. Now the markets are pushing near hitting all-time highs, and really people are buying into this market up here. I think it's kind of camouflage with, Oracle has now kind of just came out of nowhere. And, Larry, he's like, you never really hear much about him, it seems, and now he's the wealthiest man in the world, and he's like silent. And Oracle came out, and I think it's going to revigorate, some of the tech space and make people even more bullish on the market. And of course, it jumped like 30+% the other day. And so the markets are getting dragged up mostly by the big techs. We are seeing some broad market rally. We're seeing small caps. They've been moving up and equal weighted, but it still is really the magnificent seven. And so the stock market is in an uptrend. You do not want to fight it. You just need to have a game plan so that when things do stall out and price starts to roll over, first of all, you can identify when the trend up has come to an end, and to have a game plan to at least avoid a crash or benefit from falling pricing. And then if we zoom into the shorter term here, Danny, we just look at the 30-minute chart, really over the past week, the stock market has gone from this lime green, this oversold market condition where it's sold off too quick within this uptrend. Lime green is an indicator, is part of an indicator that tells me when the market is too oversold, is usually when value hunters step in, bargain hunters or institutions, and they buy it back up, and you can see it's rallied. And it's done this a couple of times. When we just zoom back here on the S&P 500, it can get sold off, it can get into this oversold condition, and it gets bought right back up again. So we're still in kind of that buy the dip mentality. We did have an interesting scenario yesterday where we had this red indicator, get above this blue line. This is my FOMO indicator. This is everybody seemed to be piling into the market yesterday. They don't care what price they pay. They're using market orders, which means they're buying at market, and they don't care what price they pay. When there's a ratio and this red indicator goes over 3, it's telling me that people are just moving in, and they believe the market's going higher, and they don't want to be left behind. And so usually after that, we have a little bit of a pause or pullback. And really, it's as soon as we got up into that territory, the market's really been trading sideways for this last day and a half. We might actually see it pull back a little bit for another day or so. So, you look at long-term gold, be aware the music will come to an end at some point. We look at the daily chart. It's up, but it's a very weak market.
Chris Vermeulen emphasizes that gold has had a strong run recently and is now pausing in a sideways bull flag, which often signals it's ready for another breakout soon. While money has rotated into silver and gold miners, those positions may see profit taking, with flows cycling back into gold. Chris prefers gold, whether physical or through ETFs. They warn that if equities drop sharply into a bear market, even gold could face temporary selling pressure from panic and margin calls, but it usually recovers faster than stocks. Current conditions resemble 2007, where gold continued to rally even as equities topped, suggesting more upside before any broader correction. Let's dive into the interview.
No, so if we look at gold, all it's done is, we can look at the 30-minute chart over the past week and a half. Gold has had this a very strong move, and after something's had a strong move, it's just taking a pause. I wouldn't say it's weakening, it's just taking a breather because it just had a hell of a run. It's exhausted. Right. There's just some profit taking. And so even when we look at the daily chart, which is very similar, we're just trading sideways, and it's a little tiny bull flag. It's primed and ready to shoot up literally, the next trading session, this thing could pop and run. And so I think right now in the precious metal space, money is actually chasing the gold miners and the silver miners. Gold's taking a pause. Money's rotating out of gold because it just had a nice move. And we're seeing it move into like silver miners and gold miners. You can see they're extending and pushing higher. And we were long SILJ. We just hit a 20% target yesterday. We've actually closed that position out. I think now we might see, miners take a bit of a breather and a pause. And as money rotates out of miners with some profit taking, we flip back to gold, and gold has got this little pause that it's just had, and now gold will probably shoot up. So I think they're going to like piggyback on each other. That flows into miners and then flows into gold and goes back and forth. That's what I think is going to unfold here. The problem is we're coming to a turning point, and when things turn, I don't want to hold anything. So I still like gold the most, physical gold or through an ETF. I think that has got good upside potential here. I think it still has 10 to 20+% upside. I also think because I have to hold it for a year, I think bonds like TLT would be a good position as well. So the bonds could come to life and really start a nice move up, and eventually it'd be nice to sell gold. And because when the stock market does roll over, eventually gold will most likely pull back with it. But gold holds its value fairly well. It doesn't drop as much as the stock market. So I would say like gold and bonds would be those plays. If you had a gun to my head and said you have to buy and hold, it's probably the two that I would do. Short term, typically we see gold, like we could see the stock market top out and potentially fall 10-15% from here, and gold keeps going up another 10 or 20%. But eventually when the stock market falls a certain amount and people start to get really scared, there's real fear, we actually enter a bear market, then gold usually doesn't stand a chance. There's enough selling and margin calls and fear that even people sell off the good positions like gold. And so gold naturally will sell off temporarily, but it's usually short-lived. Gold only gets pulled down during an extreme wave of selling. It could last a few months in the markets, and then it'll find a bottom way before the stock market does. So yeah, gold is not immune to a bear market, but it can rally in this particular situation. 2007, which is a very similar situation as we have right now, when you look at from price charts and what the dollar is doing and what gold's doing in the stock market, the equities market could sell off and top at any point here, and gold just keeps on going another 20+%. So that's why I like gold at this point.
It is more crucial than ever to have a clear plan in place to safeguard profits and handle reversals as global uncertainty increases and stocks reveal underlying fractures. How likely is it that silver will maintain its pace toward $50 without seeing a dramatic reversal if it breaks over $44? In the event that U.S. stocks undergo a more severe decline, may gold and bonds serve as the most secure hedge? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.